Welcome to The Interest. I'm Sarah Wolak. You know them, have seen them, and have probably clicked on one of these while searching the web. But rate tables are more than just today's rates. They're a barometer to see how your competition is doing. I had the chance to sit down with the founder and CEO of Lender City, Greg Harris, to chat rate tables.
And it's really comes down to how competitive are you as a lender to be able to compete on there.
Rate tables merely provide a snapshot of different rates from different lenders in one convenient spot. But so much more goes into those tables: quality control, lead generation, and proper advertising.
So a rate table is basically a display of different multiple lenders' rates in real time, right? The cool thing about a rate table is, just like if you go on Amazon and you search for a product, it gives you the latest, or it shows you different vendors.
Greg Harris runs his own rate table platform called Lender City and says that rate shopping should be relatively seamless for the consumer. But Harris says they have drawbacks.
Those platforms have really high barriers to entry. Typically, there's a minimum monthly spend.
And the stakes are high. Not only do lenders want to offer the best rates, they also want to rat out other lenders for not delivering the rates they promised.
We get some information. It's like, you'll see inaccuracies. Somebody will have a purchase price and they'll have a down payment and it doesn't align with the loan amount. And I'm like, it's pretty simple.
You can read more about Rate Table Roulette in the latest issue of Mortgage Banker Magazine, available now at mortgagebankermag.com. For The Interest, I'm Sarah Wolak.
My name is Thomas Hall. I went ahead and used the Sunbest AI app, and I put in a difficult loan scenario with some tax returns and everything, and I had somebody else already underwrite it. When it came back, it was almost identical within like a few dollars, and it took about 30 minutes instead of a whole day or two for somebody to analyze that. So, yeah, that AI is going to be the best thing in the whole industry. So stay tuned.
Hello, I'm David Luna, and today's report is regarding insurance. Now you're thinking, well, Dave, we're in mortgages, not in insurance. You'll see how the two combine very, very quickly. We need to be aware of insurance concerns. The major insurance companies are rethinking their exposure risks in many states. In a recent Washington Post article, many of the largest insurance companies have, quote, stopped writing coverage in some regions, exclude protections from various weather events, and raise monthly premiums and deductibles, close quote. As most insurance policies are annual, these insurers are only limited to 1 year's worth of coverage. So think of the disasters just this year: fires in Maui, fires, flooding, earthquakes along the West Coast, Hurricane Alley in the middle of America, and the recent Hurricane Idalia in the Southeast. These cost insurers billions. The fire on Maui, for example, is estimated at $3.2 billion. Estimates are around $300 billion in only the last 3 years for natural disaster claims. So far, in 2023, $40 billion in insured losses. So what's happening now is that insurance companies are limiting what they will cover, meaning if an area is prone to a specific disaster, that will be excluded from the policy and coverage must be obtained from a specialty insurer. What is happening is that states are filling in where insurance companies are leaving. Look at the examples of California and Florida. This does not bode well for the mortgage industry. We need to have insurance on the properties we make loans on. There will be more changes as we move forward. Finally, the CFPB reminds us that in October, most federal student loan borrowers will receive their first monthly bill since March 2020. But borrowers may be entitled to income-based repayment programs and other loan cancellation options to reduce their loan payments or even cancel their loans. As mortgage professionals, we need to be aware of this as it will continue to affect DTI for borrowers with student loans. For The Interest, this is David Luna with MEC.
There once was a borrower, you see, with dreams of a home to decree. Their 1040 was low, but they refused to forego, so they sought out a non-QM decree. No W-2 income they could show, yet they yearned for a place they could grow. With non-QM in hand, they could finally land a mortgage that fit their cash flow. Lenders said, we'll take on the risk, though traditional norms we may brisk. With alternative ways, we'll approve your homestays and grant you the loan that you frisk. So the borrower, filled with delight, found a home that was just right. With non-QM's embrace, they secured their own space and slept soundly each non-QM night.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.